I think the other more important question, though, is okay, well, why did value lag specifically? And it's hard to really prove that, but my theory goes something like this. I think, when the economy struggles or when there's a lot of chaos out there, investors really tend to gravitate towards companies with stable earnings growth. That, to greatly simplify, really favors more of a growth style of investing. It's not black or white, and they can be two sides of the same coin. But I do think at this point, the end of last year, the best performing sectors were, I believe, utilities and supermarkets. So you might even concede or believe, as I do, that people might have been paying too much of a premium for that stable earnings growth, and in which case, well, had you done that, what do you do now? Don't know. It's a difference, I guess, between long-term value investing and trying to guess little short-term fluctuations of where the market's going to be. In any case, the point is, how are we going to know that value is coming back? Well, in my mind, it's really going to be evidenced in the financials. The financials are really the largest component, of value type indices. They're also, I think, the cheapest out there. So I suspect we're seeing part of that already as 2012 gets underway. Again, here is Tarpon year 4 so far. We are up 34% from the end of year 3 through February 15th. We're outperforming the S&P 500 benchmark by 23%. And in short, we're off to a good start in year 4. That said, please don't evaluate me as a portfolio manager based on any 2.5-month window of performance, this one included. I really included this slide here to alleviate any concerns folks might have had about year 3 specifically. Again, we have made up that loss we had in year 3 already. Still early in year 4. We appear to be off to a good start. I believe we have some room to run still, but let's see what happens the rest of this year. Wanted to share some thoughts on an outlook really from two different levels. The first being more fund specific. The economy is in mid to late cycle recovery mode, so we are fully invested. The reality is we'd probably be fully invested regardless of where we might be in the business cycle, with a few exceptions, but that's probably a whole nother discussion. And to be clear, by fully invested, I mean we have hardly any excess cash in the portfolio. Everything in there, in both Tarpon and Gecko, in other words, has really been put to work in the companies that we own. So don't have a large cash balance at all in either of them. That second bullet there is probably the more important one of this slide, though. The price to fair value of ratio of Tarpon implies right around 60% returns from here. And to clarify a little bit, the price to fair value metric is just something I keep tabs on when it comes to trying to quantify how cheap the portfolio might be overall. You can think of it as really if the values of the companies that are currently in Tarpon reach what their ultimate values, I believe, really are, then that gap should be right around 60%. So it is a sort of a back of the envelope approach to keeping general tabs on the overall cheapness of things, and right now signs would point to some nice gains. Again, all things being equal, assuming I'm doing all the analysis correctly, assuming my assumptions are in line, but I do feel positive about that right now. The big caveat, though, in that bullet number 2 and really the whole slide is the underscore of if nothing unexpected happens. Number 3, something unexpected will happen this year. It's just a given. That's how the market works. That's sort of how the game is played. So the timeline over which we're going to achieve that hypothetical 60% return is very much uncertain. Early TARP investors got a little bit lucky, I think you can say, in that it took about 13 months for the portfolio to double. So that timeline was very accelerated. My goal since day one has been to compound things at about 15% a year. So if you look over any rolling 5-year period, and if you include the effects of compounding, then 15% a year for 5 years means we've doubled our money. And that, to me, is a laudable goal. It's been my goal since day one. We've had some years higher than that, some unfortunately a bit lower, but that remains my goal today. point number 5 there, low interest rates and the degree of undervaluation bode well for performance of the gecko looking ahead as well. I don't obsess as much about price to fair value when it comes to gecko as I might with tarpon, and that's specifically because gecko is a high yield income generating portfolio. So most of my mental energy gets spent on figuring out the sustainability of current dividends, how fast those dividends might grow, and a little bit different layer of analysis. Things are cheap, but I won't necessarily buy things in gecko that are trading at 50% of what I think they're worth. Might be about 75%. So I'm willing to buy things that are less undervalued in gecko, providing the dividend is attractive, sustainable, and growing too. I think people may remember the name Peter Lynch, but he was a famous mutual fund manager up at Fidelity in the 80s, and he had a great quote about the macro economy. And Peter Lynch said one time something like, if you spend 13 minutes a year thinking about the economy, then you've probably wasted 10 minutes. And I sort of share the same philosophy. There is a big distinction to be made between a bottoms-up investor, which I am and which you guys are by default, and that is in contrast to a top-down investor. So a bottoms-up guy is somebody who really looks through companies on a case-by-case basis based on really what is just fundamentally, statistically cheap. A top-down investor is, and this is how a lot of Wall Street works, is somebody who tries to figure out where economic growth is going to be the best all across the globe for a given year or two, say. So first you identify where the best economies are, then you're going to drill down and say where are going to be the best sectors in those economies, and then another level analysis is, okay, within that, what should be a high-performing sector, what are going to be the best companies, and on, until you sort of assemble your portfolio that way. We're doing it at the end of the spectrum. We're basically just finding what's cheap and going really company by company to find the from the bottoms up perspective the cheapest, best companies that we can come up with. So that is sort of my qualifier when it comes to macro stuff. Again, I don't try to predict or project what GDP is going to be the next quarter. I think it's important to know where we are in the business cycle, but trying to guess what the actual numbers are going to look like in terms of GDP and unemployment and all that, it's just not in my game. It's not that it's unimportant, it's just so hard to do correctly that I just don't spend any time there. Nonetheless, all of you, I think, at some level want to know about my thoughts on macro, and this slide is for you guys, I suppose. Probably goes without saying, there is still a historically high level of uncertainty out there. There is a huge, wide range of possible outcomes where things could end up across the board in terms of politics, in terms of the macro world. I still believe, though, that right now there are more opportunities than risks out there, and that's just really bolstered by the looking I'm doing on a daily basis and seeing still, in spite of this little rally we've had the last few months, still seeing some very good, very cheap companies that are trading at levels that can be kind of head-scratching. There are some, to be sure, there's some companies that are overvalued or that may come public being overvalued, i.e. Facebook, but that's another battle to fight, I guess. U.S. economy did, as a point of fact, though, finish last year with some good momentum. Business fundamentals still look great. Corporate profit margins are at a multi-decade high, but so is pessimism also. People are still fundamentally pessimistic about a lot of things going on out there, and rightly so. The two together could make, anecdotally anyways, a strong case for decent returns in the next year or two just based on valuation in the market. I'm going to sort of speed past my thoughts on Europe. I tried to capture that and put it all down really for the record in my last letter to investors. At a high level, Europe has many problems, but at a high level you could sort of boil down the big ones into two categories. One being an illiquidity problem, the country's banks just being unable to fund themselves essentially, and as well as the governments. The other being an insolvency problem. Over the holidays, right before Christmas actually, the ECB stepped up and essentially flooded the market, similar to our own Fed's actions several years ago, basically injected in euro equivalent what was about 600 billion euros, which in short should solve, at least temporarily, or at least for the foreseeable future, the illiquidity problem that European banks are having. The insolvency problem is something that's still got to be dealt with. You've probably read headlines recently about Greece. They are making frustratingly slow progress there. I think it's best to steel yourself for the idea that it's going to take a while to get through all that, but it is progressing. A couple other points I guess I'd make just based on the last letter. It does appear that China is stepping up a little bit, as I sort of thought they might, just because the Euro area is a huge export market for China. Remains to be seen how involved China gets over there, but I think it's probably a good sign, at least out at the margins, for Europe the next few months to year. Greece obviously has its own problems. A whole other discussion there about what may or may not eventually happen, but for now, the short-term fire seems to be put out. Stay tuned for other fires that may pop up as the year progresses, though. Excuse me. Point number 4. There is a sort of this deleveraging versus slow but continuing recovery debate that continues. And I think it's important to mention because it really, in one way, shape, or form, whether or not you're really aware of it or aware of it in those terms, that is the source of a tremendous amount of noise, I think, in the financial media these days. Again, with regards to answering the big question on everybody's mind, and probably yours too, which is, well, why is this recovery that we're in so unsatisfactorily slow? There are a handful of different schools of thoughts about really any subject in macroeconomics, but this one I think is worth talking about. There are a lot of just a lot of smart money, a lot of very big hedge funds, a lot of the guys on the street who are convinced really that the reason the recovery is so slow is because of this deleveraging process. And let me step back and talk about that a little bit. If you go back and look between 2001 and 2007, I believe it was, the average amount of debt per household in America doubled. So the deleveraging theory is essentially that the reason consumers aren't spending as much as they otherwise might be, and the reason by extension the recovery isn't proceeding as fast, is because consumers are now focused on paying off their debts. They're focused on deleveraging rather than spending per se. And if that is in fact the case, well, then we as investors want to be more concerned about things like deflation, want to be more concerned about a specific set of problems that comes along with deleveraging versus the set of problems we might want to be concerned with if this slow but continuing recovery mode or sort of the operative way things are unfolding. The point is, when it comes to deleveraging, the evidence that it's actually deleveraging that's causing this slow recovery is fairly sketchy. Things that you would expect to see happening in the economy if deleveraging were true simply aren't happening. For instance, if you look at things like personal consumption, it's still right around 70% of GDP, the same place it's been for decades. The savings rate is not particularly high compared to where it has been historically speaking. Personal consumption has been growing. I think it's now 10 quarters in a row. It's not growing as fast as anybody would like, given the high unemployment that's out there. But the point is, it's still inching along in a way that should be, at some level, somewhat satisfactory. So historically, consumer spending is not necessarily that high. It's actually right around where it has been if you try to back out all the noise. And that, I think, really kind of leads you to question, all right, well, is deleveraging really happening or not? In my case, again, just not really seeing the evidence. I'm kind of agnostic about whether or not it's happening. I do think it's important to have somewhat of an opinion, really, when it comes to deflation versus inflation and managing the portfolio. But let me step back. The question then becomes, okay, well, if it's not deleveraging, how do we explain the slow recovery? And I think the economists have a term that's called the housing wealth effect. And I think this is more likely the scenario. From something like 2006 to 2011, U.S. home values dropped by about $7 trillion. So there's a huge drop in the household wealth that people felt, if you will. That alone, they can show, economists have shown there's a correlation between that increase in or decrease in housing wealth and just demand and consumer spending in general. So my point to you guys is I don't think there's really a need to sort of roll out any academic theories to try to explain what's going on. I think, and this probably is somewhat intuitive, I think we can just look at what the bursting of the housing bubble did to the economy to really explain why the recovery is so slow. There's just a huge shortfall in aggregate demand from the consumer really across the board. I read something somewhere that said the average American household lost about 25% of its wealth related to this most recent bursting of the bubble. So again, I don't want to spend too much more time on it, probably already gone down the rabbit hole, but my high level point, I guess, is number one, that huge debt that's out there is unequivocally a problem, both for us as Americans, for the government. But my point is that removing it all right now, if we could make it all go away right now, this second, it's not necessarily a cure-all. It's not a panacea for the economy in general. Again, that evidence that deleveraging is what's causing this is, in my mind, still pretty sketchy still. And all of that means that, as I tried to articulate a couple of years ago in one or more of those letters, it's really corporate America that's kind of dragging us out of this recession. It's been slow, slower than anybody would like, but if you sort of presume that the government's already done everything it can do to step in and goose things a little bit, then now more than ever it's going to rely on businesses and I guess by extension exports to keep pulling us out of the Great Recession. So the fact that corporations are doing well right now is a good sign for the year 4 outlook, to try to bring all that back. The last point, number 5 there, on a back of the envelope basis, it's probably deceptively easy, but you can still sort of do the math and say, okay, well, the S&P 500 in aggregate last year had earnings growth of right around 15%. I think it'll be when it's all said and done, but returned 0% in terms of stock market returns. So while you could concede, and I do concede, that corporate profit margins could be unsustainably high right now, even if they come down off that high level, there should be enough earnings growth in there to, long story short, result in what could be an 8 to 12% type year, and by that I mean an 8 to 12% return in the broader market this year. So again, asterisk, that assumes there are no huge surprises, but on paper, you can sort of intuitively rationalize that if things were somewhat cheap at the end of last year and the market didn't go anywhere and companies are doing really pretty well still, okay, well then if market prices follow earnings, which in a rational world they eventually will, then that's a good sign for the year ahead here.